for joining me in this PowerPoint presentation. Today's topic is retirement pressures. So today we're going to go through a list of what those retirement pressures might be and also discuss a strategy that might reduce some of those pressures on your retirement portfolios, specifically as it relates to market corrections as we've dealt recently as a result of the COVID-19 situation. So let's first define what retirement is. Really what retirement is people at work to money at work. And this change results in significant pressure on our money, and it can trigger major retirement risks. So you could face a variety of retirement risks. Lack of savings is one, poor market performance as we've been dealing with recently, healthcare costs, outliving your money, lack of liquidity, tax law changes, unexpected events, and inflation. So let's talk about the first risk that we deal with our retirement savings, and that is markets can behave badly. So if you look at this chart here, from 1928 to 2008, there were a total of 24 down markets. So having enough money can overcome some financial risks, but it may not reduce financial concerns. Negative market returns can undo the best laid plans. It's not a matter of if, but when there is a correction, and these are things that we just can't plan for or anticipate. So here's another problem, sequence of returns, which is again something that it's very difficult to plan for. So in this scenario, we're going to show you the historical performance of the S&P 500 from 1973 to 1991, which has provided a 12.98% annualized rate of return over that 19-year period. The two scenarios we're going to look at is how your funds have performed if we started from 1973 to 1991, and if we reversed those years as well. So I'll explain that in detail. In this scenario, we're looking at a $1 million portfolio invested in 1973 with this performance over that 19-year period and an annual withdrawal rate of approximately 79,713. So let's see how things worked out for this investor starting in 1973 to 1991. So we'll look at the first line here. 1973, there's a beginning of year balance of $1 million. The S&P 500 by the end of the year lost almost 15% in return. This is the annual withdrawal that we took out, and this is what the end of year balance would be. So we follow the following year, same thing. Then there was another 26% loss in that year, and same withdrawal rate and end of year balance. Third year, here are the numbers, and actually we had a pretty decent recovery, same withdrawal rate, and here you go. So if we look at this scenario over the 19-year period, there were 5 market corrections. Over the 19-year period, the average return was 12.98% annualized. This is the total amount pre-tax, so this is gross amount that the investor would have drawn is $1.5 million approximately, and at the end of the 19-year period, they would have lost, or they would have run out of money in this scenario. So let's now reverse the sequence of returns. So we're going to start off with, if the investor put in their $1 million and it was 1991, and we used that first year return where there was a gain of 30.47%, there's your withdrawal rate, and there's the end of year balance. So year 2, same thing, small little loss, but we take you all the way down to 1974 and 1973. And you can see there what the losses were. So over that 19-year period, even if you reverse the order, the average rate of return was still 12.98%, because basically what you do is you take the annual return, you add, subtract, and you divide over 19 years, which gives you that 12.98% return. This investor would have still taken up the exact same amount of money, $1.5 million, but they'd still have a balance of over $3.7 million in this scenario. So clearly, the sequence of returns is very important, and there's a huge impact on your retirement account. So let's talk about another problem, which is sustainable withdrawal rates. Withdrawal rate research generally identifies 2.5% to 4.5% as a suggested amount for portfolios to last to a life horizon. For perspective, if you had $1 million portfolio, then you would generate anywhere from $25,000 to $45,000 of income in year 1 in this scenario, or you would require 2.2 and 4.4 million of assets to produce $1 million of income per year. So how do we take some of the retirement pressures off of our retirement portfolios during the retirement years? Well, we need to employ some powerful strategies, and there's three here that we're going to talk about. The first one is called sequence defense. So this will increase longevity of income and assets from market-related portfolios during retirement. The second strategy is we want to have asset insurance. This will increase your ability to spend and enjoy more money during your retirement. And the third thing is we want to implement some guaranteed income sources. So this will obtain guaranteed income to last throughout retirement with the possibility to outperform safe withdrawal rates. So here's three things that we want to implement. We want to diversify retirement income by adding a foundation of guaranteed income sources that are not necessarily market related. Guarantees to cover minimum lifestyle needs, and we want to use long-term guarantees to increase income and lifestyle in early years of retirement. So in this scenario, we're now going to look at the benefit of implementing the sequence defense strategy. So we're still working with the same $1 million portfolio with an S&P 500 rate of return from 1973 to 1991. You can see it here as well. And we're going to still incorporate the same withdrawal rates of 79,713 in this scenario. So this slide is the exact same slide as an earlier one that we went through, where we're not implementing the sequence defense strategy. And again, you can see here that after the 19th year period, the individual would have depleted all their funds, and they would have taken out a total of 1.5 million with an annualized return of 12.98%. Now here you're going to see what happens to your retirement portfolio from 1973 to 1991 if we implement the sequence defense strategy. So you'll see here 1973, all right, same numbers, but because we took out the 79,000 in year one and because there was a market correction in the following year, we actually did not draw from this investment portfolio that is market-based. And then we can see here that in year three, the same thing, and we allowed the portfolio to recover, and you can see what the market value was by the end of that year. And then in year four, because of the recovery, we started to draw money down. So if we look at here, 1, 2, 3, 4, 5, so over that 19-year period where we had 5 negative returns, there was also 5 years where we didn't draw 79,000 from the retirement portfolio. And over the 19-year period, same average rate of return. In this scenario, from the retirement account, the investor would have drawn $1.1 million, but they'd still have a balance of 2.8, almost $2.9 million by the end of that 19-year period, compared to if we didn't employ the strategy, then they would have depleted all their money because they would have required that 79,000 even in the down years. And what we did was there's about 398,000 was funded from sequence defense resources, where the investor would have still received over that 19-year period the over 1.5 million of income, but for the 5-year period we drew some of those funds from another resource. So let's look at the conventional retirement approach. So in this scenario, we're going to see here are your retirement expenses. So you have your fixed retirement expenses that are generally funded by our CPP and OAS. And if you happen to have a private pension plan, the pension plan would also provide you the income to cover off a lot of those fixed expenses. And then what happens is we have our variables and our discretionary, and typically those expenses are funded from your home. So some people might just liquidate their home and rent or downsize, and also from your balanced portfolio and your retirement plans. And from a legacy perspective, well, once you pass away, there's nothing from the government plans or from the pension plans that would be left over to the next generation. And then your home and your balanced portfolio would be transitioned to your next generation, and they would either deal with growth or loss in the real estate and or the balanced portfolio. Now, by implementing the enhanced retirement approach, here's what happens. You have your fixed expenses, so those don't change, but those are now funded, those fixed expenses, by the same government plans. If you have a private pension plan, that would also assist. but also withdrawals and loans from a whole life or permanent life insurance contract. And if we put in an annuity or hybrid annuity, all these sources of income which are guaranteed would help fund your fixed retirement expenses. And then from the variable and discretionary perspective, that still would be funded from your balanced portfolio and your home real estate. And then if we look at the legacy side of things, if or when you were to pass away, then the life insurance and annuities, depending on how they're structured, those can be passed down to the next generation as a result, unlike the first conventional approach that we talked about. And with this part here, again, your home real estate and your balanced portfolio, that would be transitioned to the next generation with either a gain or a loss in market value as well. So don't lock yourself into conventional strategies. Again, we've highlighted that if you use mostly retirement plans for retirement income, such as your RSP and or your tax-free savings account, and you're fully invested in mutual funds, ETFs, basically the public markets, the retirement income can result in the following concerns. You have the sequence of returns risks, which we talked about, limited investment options, possible tax explosion. So when it comes to an RSP, depending on how big you build that, there could be some major tax consequences at retirement and or at death as well. Increased government control, because the governments control when and how much we can draw from our retirement portfolios. Reduced or penalized accessibility. So again, the government can determine the accessibility of those funds. Forced distribution. So with an RSP, you're forced to transition that into a RIF by age 71. Lack of additional benefits, and not self-completing in the event of disability or premature death. So retire on your own terms. It's really your choice. Again, if we look at conventional retirement, excess concentration of assets in retirement plans leads to increased pressure on your overall retirement. Limited income from the portfolio due to safe withdrawal rates. So that's a concern that we have to have if you just focus on building your retirement plan in the public market space. And a lack of guaranteed income strategies can create more uncertainty and exposure to retirement risks. You can also choose to not employ conventional strategies and employ the enhanced retirement strategy. And the benefits there are your income and assets positioned in a variety of sources. So we're not just going to rely on building a RSP retirement portfolio in the public market space. Better protected against unforeseen events or law changes with this strategy. Sequence defense can protect portfolios for longevity, as illustrated. Asset insurance can increase income and provide a legacy as well. And use of guaranteed income sources to provide for fixed lifestyle expenses and address longevity concerns. So if you're interested in implementing the enhanced retirement strategy, here's some action items for you. First and foremost is let's schedule some time to discuss it further. We can do that over a 30-minute phone call or through an online webinar as well. And then from there, we would need some additional information. So I would send out a link where we can gather a lot of that data. And then we would look at creating that sequence defense strategy, fund the development of asset insurance in your retirement, and strategize to acquire guaranteed income sources. So once again, thank you for watching. And if you do have any questions, I can be reached at financial@tvhgroup.ca, or you can call at 647-727-4668. Thank you.